So hello all my dearest students of South India. I hope you all are doing good and you are doing great preparations for your upcoming November 2023 exams. So as I promised to all of you that everything that I will do it for my North Indian, West Indian and East Indian student, I will equally try my best to give you the best resources in English also for my dearest South Indian students. So we have already uploaded the video of RTP November 2023 for your direct tax paper in full English. So now today I'm going to discuss the mock test paper MCQs, that is series 1 mock test paper. Few days later I will also discuss series 2 mock test paper. Okay. So let us start without wasting any further time. The mock test paper for November 2023 in full English. The first question is a case scenario. There is a person, Mr. Ram, who is doing some business in trading in furniture. His turnover is around 70 to 80 lakhs. And Mr. Sham, whose turnover is around 11 crore rupees. Okay. Now the data for their returns are given for different years, in which year they have filed return, when. And then they are asking us some questions. The first question, I expect you all to read through the question, understand the question. My video is not to go through the question with me. My video is for better understanding of the provision. In case you are stuck somewhere, you can come and see my video. That is always my objective. I always want my students to solve first and then I can solve it for you, because that will give you more value addition rather than I will discuss the entire question, I will discuss the entire solution and you will just watch it. There will be no value addition on this. So the first question is, what is the time limit available to the AO for completion of assessment of Mr. Ram for A and Mr. Sham for AY 1819? Now, which assessment is happening in AY 1819? The assessment which is happening in AY 1819 for both of them is 147 assessment. You can check over here because both of them have received a 148 notice. Okay. Now, what is the time limit to complete a 147 assessment? The time limit to complete a 147 assessment is within 12 months from the end of the financial year in which the notice under 148 is served to the assessee. So, in whichever year the notice is served to the assessee, from the end of that year, you will take 12 months. Sir, where it is written? It is written in section 153 subsection 2. So, in case of Mr. Ram, when is the notice served? The notice is served in March 2020. So, 12 months from the end of March 2020. It will come to 31st March 2021. 12 months from the end of March 2020 will come when? It will come to 31st March 2021. So, for Mr. Ram, the due date would be 31st March 2021. What is the due date for Mr. Sham? Again, you have to take the date. You have to take the time when it is served. It is served now on 9th April 2020. This falls in financial year 2021. So now you have to count 12 months from the end of 2021, which will come to 31st March 2022. And therefore, for Mr. Ram, the due date for completion of assessment would be 31st March 2021. And for Mr. Sham, it would be 31st March 2022. Okay. I hope it is clear to all of you. Second question, it's a complicated question. This one is, what is the time limit available to AO for completion of assessment by passing order under 143.3 for AY 1920? Now let me tell you. For AY 1920, the time limit today, the time limit is 9 months from the end of the relevant AY today in AY 23-24. But in AY 1920, the time limit was not 9 months from the end of relevant assessment year. In AY 1920, the time limit was 12 months from the end of relevant assessment year. I have told you earlier the time limit was 12 months. Now it is what? Now it is 9 months. So are we supposed to remember all these things? By looking at this MCQ, maybe yes, but that is something which is very, very wrong. A student cannot remember the time limit of the earlier years. Yeah? Year by year, the time limit changes. So am I supposed to remember the time limit of all the years? This question tries to tell us that only, unfortunately. Nevertheless, I have to give the answers, I am giving it. Okay. Whether to remember or not to remember, you can take a call at your end. Okay. I personally don't think so. It will be possible to remember. Now, for 1920, the time limit was 12 months from the end of relevant AY. So, for RAM, it is 12 months from the end of relevant AY. 1920, 12 months from the end of relevant AY. For RAM, it will be 31st March 2021. Now, for Sham, it is 24 months. Why? Because in case of Sham, in 1920, you can see the AO is referring the matter to TPO. Now, always remember, whenever any matter is referred to TPO, then you get extra 12 months. Yes? And because you are getting extra 12 months, so in case of Sham, the 24 months will complete on 31st of March 2024. Check it, please. 22, sorry. Check it, please. So let's move on to the third question now. What is the time limit available to AO for completing the assessment of Mr. Ram by passing order under 143.3 for AY 21-22 and for 21-22, 2021 and 21-22. Now again the time limit has changed. For 2021, if you go and see the Bare Act, it is 18 months. And for 21-22, if you go and see the Bare Act, it is 9 months. The time changes every year, and that is what they are targeting in the exam now. It is they have not asked in the exam. Obviously, this is a mock test, not an exam paper. But nevertheless, if they start to ask such things, then the things are slightly dicey. Okay. So 2021, the time limit was 18 months from the end of relevant AY, and 18 months from the end of relevant AY will complete on 30th September 2022. And 21-22, it will come to 9 months on the end of relevant AY, and 9 months on the end of relevant AY will come to 31st December 2022. Check it, please. I hope it is clear to all of you, right? Now, the last question over here, Mr. Ram and Mr. Sham have business losses pertaining to AY 22-23. Can they carry forward and set off the loss against the business income of 23-24? Now, let's see. There is one primary condition to carry forward and set off the loss, and the primary condition to carry forward and set off the business loss and capital gain losses, you have to file the return on time. So, if you file the return on time, then you can carry forward and set off the loss. Otherwise, it is not possible. So, now the question is, what is the due date of Mr. Ram? See, Mr. Ram's turnover is 70 to 80 lakhs. Therefore, for him, tax audit is not mandatory. And because tax audit is not mandatory, for him, the due date will be July. Now, he is filing in September for AY 22-23. Check. We are talking about AY 22-23 in question number 4. So, because his turnover is less than the limit of tax audit, he is not conducting tax audit. His due date would be July, but unfortunately, he is filing in September. Therefore, he cannot carry forward the loss because he is filing a late return, belated return under 139.4. But for Sham, the tax audit is applicable because for Sham, the turnover is 11 crore rupees. And if an assessee turnover is 11 crore, tax audit is mandatory. And if tax audit is mandatory, then the due date of filing of return is 31st October for Sham. But Sham is fortunately filing the return on 30th September. Therefore, Sham can carry forward the loss over here. You can check it over here. Ram cannot carry forward the loss, but Sham can carry forward the loss. Check it, please. So, let's move on to the next case scenario. Case scenario number 2. Now, what is happening in this case? There is a firm, partnership firm, whose assessment was done on 28th of March, and AO made 2 additions. The first addition was some disallowance with respect to non-deduction of TDS. And second one was with respect to unexplained cash credit. Now the assessee has contested in the appeal the second one. So this one was filed as an appeal by the assessee. Okay. And then there are some more informations which are given below. You can go through the information once. I want you all to go through the question once. Okay. Now I am interested in the answer, not in the question. So the 5th question over here, what is the answer? Would Shubh Associate be entitled to carry forward business loss and unabsorbed depreciation claimed in the return for AY 21-22? Now let's see the scenario for that. See here, please. The answer to this question is given in this paragraph. So AO has issued a notice under 142.1 to Shubh Associates for AY 21-22. Now what is notice under 142.1? A notice under 142.1 is a notice which is issued by AO or some other prescribed income tax authority if you do not file the return on time. So this notice is issued after the due date of filing of return, because this notice is issued to those people who do not file the return on time. And therefore the question over here is, obviously this return which you are going to file is always going to be a belated return. And if it is a belated return, it is not possible to carry forward business loss. Yes. You can carry forward the unabsorbed depreciation. There is no harm in that. But carrying forward of business loss is not possible in this case. Okay. Therefore, because this return is a belated return, it's a late return, a 142 return is always after the due date. You can carry forward UAD, but you cannot carry forward what? Business loss. Okay. I hope it is clear to all of you. Now, the next question is about doctrine of partial merger, which we have done it in class. Can Shubh Associates apply for rectification under 154 or revision under 264 with respect to addition of 5.5 lakhs on account of unexplained cash credit? So now, for this 5.5 lakhs, assessee has already filed an appeal to CIT appeal, and the appeal was decided against the assessee. Now, the doors of 154 are closed for the assessee, and the doors of 264 are also closed for the assessee. Why, sir? Because 154, that is rectification of apparent mistake, and 264, that is revision by CIT, both the section says that if any matter has already been considered and decided in an appeal, then that matter cannot be reopened in rectification or revision, and this is known as doctrine of partial merger. Therefore, unfortunately, now nothing is possible for the assessee. The only thing which is possible for assessee is assessee can go to High Court and file a writ petition. Assessee can go to High Court and file what? File a writ petition. Okay, check it please. So let's move on to the next question. Question number 7. Would any penalties leviable for installment received by NBFC? If yes, what would be the amount of penalty and who can impose such penalty? Now, you might be knowing that no person can receive 2 lakh or more from any other person other than the 4 modes. So if you want to receive 2 lakh or more from any person, you should receive by account pay check, account pay draft, ECS, or such other electronic mode as may be prescribed. And if you receive 2 lakh or more, say in cash or in bearer check or in cross check, which is not an account pay, then there will be a penalty which will be imposed under 271 DA, and that penalty is imposed by Joint Commissioner. Okay. So this is given under section 269 ST. So here the NBFC is receiving the following amount. So whether 269 ST will be applicable in these cases or not? It is applicable if the amount received on a particular day is 2 lakh rupees or more other than the 4 modes. So in first case, it is not applicable because it is less than 2 lakhs. Second case also not applicable because it is account pay check also and it is less than 2 lakhs. Third case also not applicable because it is Bhim UPI is allowed, therefore not applicable. Fourth case also not applicable because it is again less than 2 lakh. Fifth case also not applicable because it is against less than 2 lakh. Sixth case it is applicable. Yes, in sixth case it is applicable because it is received in cash and it is 2 lakh or more. Therefore, penalty of 3 lakh will be imposed under 271 DA by the Joint Commissioner. It is not imposed by any random assessing officer. It is imposed by only Joint Commissioner. Okay. I hope it is clear to all of you. Next one. Is tax required to be deducted by firm on payment of interest to Mr. Ajay and Mr. Anil? Now remember, if a firm is paying interest to its partner and if the partner is resident, then no TDS is required. Sir, where it is written? It is written in 194A. So if the firm is paying interest to resident partner, no TDS. What if the partner is non-resident? Then the firm has to deduct TDS under 195. So we need to find out the residential status of Anil and Ajay. You can see over here, Anil is a non-resident. Therefore, in case of Anil, you have to deduct TDS. Ajay is a resident. Therefore, in case of Ajay, there is no need to deduct TDS. Check it, please. So for Ajay, no TDS. For Anil, yes, required to be deduct. I hope it is clear to all of you, right? One last question of this particular case scenario. What is the amount of interest to be allowed while computing business income of the firm for AY 23-24? Assuming that the tax deductible at source, if any, has been deducted and deposited on time. Now listen carefully. How much interest the firm is paying? Now see here. The firm is paying an interest of 7 lakh rupees. But the clause for payment of interest was modified in June, but with retrospective effect from April. Can you do so? Can you modify the interest clause in June? Can you write in the deed that in the month of June, can you write down that interest will be paid retrospectively from April? The answer is no. It has to be prospective. So first of all, it has to be prospective. It has to be counted for only 10 months, not 12 months. You have paid it for 12 months, not allowed. Secondly, it is allowed only up to 12%, not more than 12%. So what we'll do, we'll first of all find out the capital amount. So 7 lakh is the total interest which you have paid to the partner, and the rate of interest is 14%, right? And therefore the capital amount would be how much? 50 lakhs. So this is the capital of the partner in the firm. Now we will try to calculate the interest which is allowed. How much is allowed? Only 12%. And that too for how many months will you get from April? No, you'll get it from June. So multiplied by 10 months from June divided by 12, answer will come to 5 lakhs, and therefore the answer to this question is what? Check it please. It is 5 lakh rupees. Check. So let's move on to the next question, that is question number 10. Now these are individual MCQs. Let us talk about all of them one by one. Now there are two companies. One is, pay attention please. One is A Limited, which is in Singapore, okay, and one is B Limited, which is in Malaysia. Now the B Limited company has a PE in India. So B Limited has a PE in India, okay. A Limited does not have a PE in India. Now both of them are giving me some online services, some advertisement, some services, something like that. A Limited is also giving me some advertisement online services. B Limited is also giving me some advertisement services online. Now A Limited does not have a P in India. B Limited has a P in India. Now in case of B Limited, I can directly say, because B Limited does not have a P in India, equalization levy will not be applicable in case of B Limited. Sorry. Because B Limited has a P in India, sorry. Because B Limited has a P in India, let me just strike this off so that you are clear about what exactly this has to say. Because B Limited has a P in India, therefore no equalization levy. Because the basic criteria to levy equalization levy is that the non-resident should not have a P in India. Okay. So because there is a P of B Limited, you can check over here, B Limited has a branch in India. Therefore, equalization levy cannot be applicable in case of B Limited. A Limited does not have a branch in India. Therefore, in case of A Limited, equalization levy will be applicable. Now, the question is which one? There are two equalization levy. One is of 2016, one is of 2020. Which equalization levy will be applicable? Now, we have to be very careful because we are making the payment to B Limited of exactly 1 lakh rupees. Exact 1 lakh, which is not exceeding 1 lakh. If it exceeds 1 lakh, then 2016 equalization levy is applicable. If it does not exceed 1 lakh, then 2020 equalization levy will be applicable. Because for 2016 equalization levy, which is covered in section 165, if you want to make that applicable, the 2016 one, your payment to the non-resident should exceed 1 lakh rupees. Here it is exactly 1 lakh. Therefore, 16 equalization levy will not apply. 2020 equalization levy will apply, and in 2020 equalization levy, the limit is how much? The limit is 2%. The rate is 2%, and the turnover of the assessee should be at least 2 crore rupees. The turnover of A Limited should be at least 2 crore, which is 3 crore over here. They are providing some online advertisement services to us, okay? And they do not have a branch also in India. We are making the payment of up to 1 lakh. Therefore, 2020 equalization levy will be applicable here. Okay. Now, next question is based on your 94B. When is 94B applicable? Limitation of interest. In case of 94B, the borrower has to be either of the 2%. First, the borrower has to be an Indian company. Second, the borrower has to be a foreign company having a permanent establishment in India. So we come under the second case. This is a foreign company which is having a PE in India. So it's an eligible borrower. Who should be the lender? The lender should be a non-resident associated entity. So if a non-resident associated entity gives a loan to Indian company or to a permanent establishment of a foreign company, limitation of interest provisions will apply. Now, how much loan we have taken? We have taken a loan of 900 crore. And what is the EBITDA of the company? EBITDA of the company is 150 crore. So how much is disallowed under 94B? the disallowance under 94B is lower of the two. How much, sir? It is interest, that is 10% of 900 crore will be our interest, because the loan is 900 crore, the rate of interest is 10%. Therefore, the total interest of the year will come to 90 crores. So, what is your point number one? Point number one is interest in excess of 30% of EBITDA. Your interest is 90 crore, your EBITDA is 150 crore, take 30% of 150 crore. 30% of 150 crore will come to 45 crore. So 90 minus 45 will come to 45 crore. Point number one. What is 90? Interest. What is 45 crore? 30% of EBITDA is 45 crore. So you have to take the difference as point number one. What is point number two? Point number two is your amount paid as interest to the non-resident, and that is 90 crore. Whichever is lower will be considered as what? Whichever is lower will be considered as your amount to be disallowed. Therefore, the amount which will be disallowed over here is 45 crore, and the amount which will be allowed over here is also 45 crore, because the total interest is how much? The total interest is 90 crore. Okay. So out of 90 crore, 45 crore will be disallowed, 45 crore will be allowed. The next question is a very simple question. Air India is paying some landing and parking charges to Airport Authority of India. So the TDS will be deducted under which section? In this case, the TDS is not deducted under 194I, it is deducted under 194C. It's a contract. It's not a renting of land and building. It's a contract as held by the Supreme Court in the case of Japan Airlines. And how much TDS will be deducted? Airport Authority of India is a company. Therefore, in 194C, you will deduct TDS at the rate of 2%. Check it, please. Now, next question, question number 13. Question number 13 is based on grandfathering clause and section 112A, where there are two associates who are selling some shares on which STT was paid both at the time and sale. Therefore, 112A, both at the time of purchase and sale, STT was paid. Therefore, 112A will definitely be applied over here. Okay. Now, we have to just make a normal routine calculation. Let's talk about Mr. Rajan first. Mr. Rajan is selling 300 shares at what price? At 3,200 each. So 3,200 into 300 shares will come to 9,60,000. Now, how will I determine the cost of Mr. Rajan? For determining the cost of Mr. Rajan, we have to follow what? Grandfathering clause. And what grandfathering says? Grandfathering says that step 1, you have to compute the cost of the shares. The cost of the shares is 2,500. Then you have to compare the cost with the selling price or FMV as on 31st Jan 2018. The selling price is 3,200 and 31st Jan 2018 FMV is 1,800 rupees. Check. So whichever is lower will be your point number 2. And then you will compare this with point number 1. Whichever is higher will become your cost. Okay. So how will you determine the cost? Step 1, cost. Step 2, lower of 2 items. FMV on 31st Jan 2018 compared with selling price, whichever is lower will be your step 2. Compare that with step 1, whichever is higher will be your cost. So here, therefore, the cost ultimately comes to 2,500. Therefore, 2,500 into 300 shares, 7,50,000. Therefore, in case of Mr. Rajan, there is a long-term capital gains of 2,10,000. You can check it over here. Check it, please. The same way we have to do it for Mr. Rajan's brother Ravi also. Ravi is selling 600 shares at how much? At 1,700 per share. Therefore, 600 into 1,700 will give you 10,20,000 rupees as your sale consideration. Now, how to determine the cost of Ravi? Same. Actual cost 1,900, as you can check over here. Compare that with FMV. FMV was on 31st Jan is 2,400 and the selling price is 1,700. So, the lower of the two will become your point number 2, step number 2. Then this and this, step number 2 and step number 1, whichever is higher is your 1,900. So, you will compare 1,900 into 600, you will get 11,40,000. Your sale is just 10,20,000. Therefore, there will be a loss of 1,20,000 rupees over here. In case of Mr. Ravi, you can check it over here. So, it's a very, very simple question. Okay. Now, next question is Mr. Valish, who is an individual and he is working in a company. He is paying a rent of 50,000 per month. The question over here is he liable to deduct TDS? Now, 194I is not applicable for him. Why? Because 194I is only applicable for those individuals and HUF whose last year's business turnover is greater than 1 crore rupees and last year's profession turnover is greater than 50 lakhs. Now, because Mr. Valish is not a businessman, he is not a professional person, he is an employee of a company. For him, 194I is not applicable. Then is 190 for IB applicable? IB is also not applicable because for IB to apply, the rent per month should exceed 50,000 rupees. Exact 50,000 rent, IB is not applicable. Therefore, I is not applicable and even IB is not applicable. Therefore, Mr. Valish is not liable to deduct TDS. Check it, please. Okay. Now, one last question over here is, pay attention. The benefits of presumptive taxation under the income tax would not be available to Akash, a non-resident. Who is an Akash? Akash is an individual. It will not be available to this Akash individual. So, for whom it is not available? Operation of ship is covered in 44B. Is it available to individuals? Yes, it is available. It is available to non-resident individuals. Operation of aircraft, 44BBA. Is it available to individuals? Yes, it is available. Civil construction in connection with an approved turnkey project. This is not available to individual. Go and check. This is only available to foreign company. Therefore, this is not available to individual. Last one. Plying, hiring, leasing of goods carriage. Yes, this is also available to individuals. Yes. In fact, this is available to resident and non-resident both. Okay. Only the third one is not available to individual. Okay. So this is what your mock test paper is all about. Mock test series 1. I'll very soon come with the mock test series 2 also. Okay. So till then, take care all of you, all my dearest students of South India. I hope you all are doing good and you will do great in your exams. Don't worry about it. Okay. Bye all of you. Take care.